Good afternoon, everybody. This is David Friedman with my co-host Dave Berkus on TCA Crossroads, where we can give lessons learned to both the entrepreneurs and the investors. How are you, David?
Well, it has been a month, or depending on who's listening and for how long, a week. The Angel Capital Association has completed its summit for the year, and you're going to talk about that. And we're going to
Right.
tell some stories. And the annual meeting of TCA has just finished, and that was amazing. What we're going to talk about today with AI and our next week's one where we put some metrics to this is such a disruptive period, more so than either of us have ever thought about in the past. So today's going to be important because you discussed that at length at the summit. And we've been thinking about it. And our companies, those companies in our portfolio, are dealing with this on a daily basis.
All right, I'm going to bring up the slides and there we go. Yeah, so this is just going to focus on what I saw at the ACA summit last week. And this is the third week in April when the summit took place out in Westminster, Colorado. And it was interesting. There were 5 areas that I thought were really interesting. Number one is the AI question. Is AI right? What's the right thing for AI? What's the right way to use AI? And even to the point of how do you evaluate AI type deals? The second area that comes up seemingly every year is safe notes and structure. Is safe the right answer or not? And another one was AI powered due diligence, or how do you do due diligence in a better way? Finding the best deals is always important, not only for the investor, but also there's some lessons learned for what the entrepreneur can do. And then growing angel groups, because that was still an issue as we see angel groups kind of like pull back. And it's kind of interesting because I'm not a big fan of saying that we're angels anymore because we're early stage investors. I mean, we changed TCA to TCA Venture Group for that reason, so we can enable our members to invest in what they want and include within our venture group other investment entities, be they family offices, be they micro VCs, even VCs and corporate VCs. I mean, pretty interesting.
And I changed the way I describe myself to people to early stage years ago because the word angel has become a little bit trite. And
Well,
early stage gives us more flexibility.
so that's going to be harder for me because I keep calling you a super angel, and it's going to be hard to say a super early stage investor. I mean, it doesn't have the same cachet.
I gave a keynote in Fort Worth last month, and the headline in their advertisements was World Famous Angel Investor to Keynote. And I loved it. So I have it on a plaque now because nobody else will ever call me that. And I won't call myself that. So there you are.
Well, I'm going to get into only 3 items on this thing. They're all going to focus in the same area. So it's going to be the safe notes and structured AI powered DD and finding the best deals. I think that's a good focus for today. We can talk about the AI right question in one of your podcasts, the one that we'll do the one that's going to come up after this. And then growing angel groups, that's a whole different discussion. We may want to bring on a panel and see how people like C10, New York Angels, and some of the other biggies, have worked.
That would be fun. Oh, that's good. That's good.
Yeah. So right now I'm going to just talk about safe notes and deal structure. I'll go through some of these points, interrupt me, or we can talk at the end. But there's some pretty interesting information here in a very condensed 6-point slide. And the ACA took place over like basically 2.5 days. Number one, strong consensus. We hate it, safe notes in general because of the governance issues. This goes to a point that you have continually raised. Governance is really important. With good governance, you have the higher potential for better returns and better IRR, better multiple on invested capital, MOIC. No board seat, no rights. Number two, focusing on dilution, not just value cap. So even if I have a value cap of 30 million, that may be preferable to having an initial value of 10 million, but you have 3 additional rounds of investment, which dilutes the the investor. Number three, we talked about risk-adjusted returns. This is important. It relates to something we'll talk about, like in the investment thesis, early stage angel versus private credit versus venture debt. So we are now considering looking at, especially in like TCA, different instruments early on and different strategies which give us a quicker return as well as the longer 10x plus return. I keep reminding people a 10x return in 10 years is only 23% IRR. You're the one that got that question right, by the way. I remember doing this at the TCA meeting, and it at 23%, it sounds good, but I know I can get less risky investments at 18% if I do it right. So that's an interesting risk return. Another one is alternative models are gaining traction. You have dividend-based, revenue-based, hybrid structures. So it doesn't only have to be preferred. It doesn't only have to be equity. It doesn't only have to be interest. Going back to that earlier point on a 10x return, it may not be realistic. Are quicker, smaller returns undervalued? For example, George Carpenter, who's the president of TCOC, has literally laid out an investment thesis called the barbell strategy, where we have the 40% IRR returns in 2 to 4 years versus the longer term big winners that are 7, 10, 15x over the longer term. And finally, QSBS, the qualified small business self-attestation, should now be a part of the standard deal hygiene to make sure that we do get our returns. So that's on safe notes and deal structure. I'll turn it up to you, open to you for discussions. I know you're real big on the governance, and I totally agree with you.
Let me start by saying I hate safe notes. And that's an exclamation point twice. Let me give you an example. Two things. Number one, I have been coaching a young entrepreneur. He was a student at Purdue, and he and his partner left Purdue to move to the Valley because they were in the most recent class for Y Combinator. And, I've been coaching the guy. And so I was ready to invest in his first round. And he presented me with a Y Combinator safe note at a $10 million post. Brand new company, no anything, just the idea. Now, I did invest 10 grand because I had been coaching the guy, but I don't feel good about it. And so there's number one. Number two is I am coaching another, and this company offered me a safe note last week. And the safe note was kind of typical. And so the agreement that went along with it did not define anything except the 0.25%, which I've said many times, David, is what an advisor should expect to get. He wanted it over 4 years. I made it best over 2 years. He accepted that. But then he said 0.25%. I can't tell you what 0.25% is until the next round. Which, if you've been thinking about that, David, means that next round's going to delete us before the 0.25% is issued.
Correct.
And he can't tell you the price because, of course, it's unpriced. So I ended up negotiating that this safe note will be 0.25% of the shares that are today fully diluted, meaning with his option plan, and that the price per share can be fluid, but I made several things about it. If you don't have a price per share today, is either 30% of the amount of any round that turns out to be a preferred equity round, so it's a discount of 70%, or it is the price of the preferred round if the preferred round is below 2 million. And I had a couple of other things. And I was just adding things to that safe just to try and protect myself. Nothing to do with governance because we have too small of a piece in both companies for me to expect us to have any governance. And you know how we feel about that. We know that we are, because of stats we've seen, and I know from experience, 14 times more likely to have a great exit. Maybe it's a 14 times higher exit, whichever, if we are helping to steer the company as a member of the board, even if we're only an observer.
Correct.
So that's what I do. I am an observer of lots of companies, still a board member of 6. So my comments are real, and it tells you why safe notes are dangerous.
Yeah, so we had a dinner with a variety of angel groups, some pretty large angel groups, including QCA, Frontier, um, RTP. I'm trying to remember all the ones that were there. Rocky Mountains, and in general, maybe about most of the people wouldn't touch a safe note, even if it's post money. I'm okay with a post money, but what I do and what we do, not me, is we add a side letter to cover other areas that are really critical. Otherwise, we won't do it. I absolutely don't. I don't have a problem with a post money safe without interest. Interestingly, because my belief, I may be right or wrong on this one, is that without interest, it's equity, not doesn't look like an interest payment or an interest bearing note. And therefore, I can start the time clock for the QSBS at the time I invest in that safe because it looks like an equity type round without the specifics on what that equity would be. So
David,
that's the way I look at it. I may be wrong, but that's the way I'm thinking about it.
has the IRS ruled on that? I mean, I would
No.
love to believe that, but no, I don't think that's true at all. I'd love to believe that. And yes, you're right. If you don't receive interest, you would claim to the IRS that it's equity, but they have never ruled on whether a safe is debt or equity. And it's one of the reasons that it kills me, because until the safe is converted into something, it definitely is not equity in the mind of the IRS.
Well, I can make arguments, but I'm not a lawyer. I'm not a tax accountant. But it's certainly if it looks like a duck, quacks like a duck, it's a duck. So if it has interest, I know I can't do it. If it
Well,
doesn't have interest, it's just my opinion. I think it's a defensible position. The IRS hasn't ruled. It's up to you, your accountant, and the way you position it. But the point on all this is, QSBS is a very important type of benefit for us early stage investors. And with the big, beautiful bill, we now have the 3, 4, and 5-year rule, not just the 5-year rule. So it becomes really critical in terms of the potential return.
do you want to define QSBS for the listener?
Qualified small business, and it has a requirement to be below a certain amount of revenue and a certain number of years in business. I don't know it off the top of my head. There's about 5 different points, but fundamentally it's startups that are C corporations that have a less than a certain amount of revenue and less than a certain capitalization. I think the capitalization has to be under 50 mil.
And by the way, your gain is capped at 10 million. Wouldn't we like to see that?
I wouldn't mind the 10 million. I mean, I wouldn't mind the $10 million gain. And interestingly, on QSBS, some states follow the federal law. California, of course, follows state law. So they do not, you pay taxes on the QSBS for California. When I bought this house in Georgia, although I'm a resident in California, so I'll be paying state income tax on the QSBS. If I had residency in Georgia, I would not be paying that. Just point that out.
And by the way, your capital gains and ordinary income are the same tax rate at 13% in California.
Well, thanks for making that. Let me go on to the second slide now that you've just made me reach for my digel.
Yeah. Mm-hmm.
All right. So now we'll talk about an area that had received a lot of discussion, several panel discussions on due diligence in the AI era. So we know that AI assisted due diligence is here. We're doing this at TCA. I've given talks on this and showed the methodology or the workflow, as we call it. But the human stays in the loop. It's very critical. You don't want AI to go rogue on you in a sense. But in general, the due diligence revolves around collecting data from the entrepreneur, as collecting data, from outside sources, review, acting. But the key thing here is a structured due diligence process. It's not ad hoc. And in line with that structured process are dedicated checklists for fundraising, financial, technical, legal, and commercial. So one gentleman, Sam Wong, who is an angel investor and also a consultant, had provided a variety of the angels' checklists for each of these areas to make sure you don't overlook anything. pretty good. Most of us who have done this for a while kind of have this in their minds by rote. You need to put somebody in charge of each section for accountability. So even if you use AI and spit out a 40, 50 page due diligence draft, you need somebody, this human in the loop, to review it to make sure it makes sense and just to take a look at seeing if, in fact, it covers all the bases. Exit analysis tool. The model, you need to model the outcome before you write the check. And this is particularly important to go back to the earlier comment I made about dilution. What are the options in terms of the revenue stream? What's your scenarios? What's the worst case? What's the best case? What's the norm or the conservative case? And what happens when you have multiple levels of dilution? I'm going to a bridge, I'm going to an A round, I'm going to a B round relative to the exit. AI can hallucinate. Double check AI generated research independently. I can't tell you how many times that word had come up. It's like going to Staples with that red, button. Every time we talk about AI, they were clicking that button saying AI can hallucinate, keep human in the loop. However, agentic AI is now being used for screening. And that screening is done in terms of the dashboard, taking a look at the triage of the deals, developing rejection letters. Using Claude is great. You can use a Claude with Copilot and the AI to send out the rejection letters based upon what you determined that in the triage. And these tools, these AI tools, have become really important for each member. So I'll turn it over to you for discussion.
Due diligence is obviously important. And, there are stories we all have. In my case, I was an expert in the field of spa management. That sounds a little strange. When TCA had one company come in front of it that was a spa management company, but I had been the chairman of another company in Atlanta in the same industry, and I stepped back and said, there's a conflict of interest. My company went broke, and the company that TCA invested in ended up with, David, you remember what the multiple was? But 233x. Bottom line is, if you have experts in on due diligence who know an industry very well, it will often help guide you and the entire group in what decisions to make. And so I'm very heavy into how any kind of benefits for due diligence will improve the accuracy as well as the opportunity. If we have a 2.5% opportunity, which is a real number, to make 10x, that's 2.5% of all we see. And that's more like, I'm not sure what the percentage is of those we invest in. Assume it's much higher than that. But if it's only 2.5% of all we see, we ought to be able to figure out very quickly which ones we ought to look at more closely. So due diligence has its purpose in many ways.
Yeah, let me just comment on one other thing that came up from John Harbison's research. The wisdom of the crowds is not necessarily going to be the best answer to come up with the highest returns. It's really a few very wise people who understand that market segment, understand that technology, that have this passion and say, this is the greatest thing since sliced bread. And those few really are the ones we should listen to.
And that's why some of the very biggest deals that TCA has done, going way back to the beginning, only had between 3 and 6 people that actually got into it, because those are the passionate people that understood it, or sometimes that made the leap. But it isn't like the whole group of lemmings followed everybody. And that's something to know.
That's a good thing to say. And with the focus on lemmings, I'm going to go to the next slide.
Sure.
I didn't think that was a great transition, but it came out of my head that way. All right, so how do we find the best deals? Interesting, this is a panel that I actually moderated. So a lot of these findings come out of that panel. Most angels still lack a written investment thesis. They're reactive. They look at what's coming over the transom, not intentional. I asked the question, how many in an audience? I have about 100 people in my session. And no more than 20% had an investment thesis. And I thought that was extraordinarily surprising. A barbell strategy, like I mentioned, that we have in TCAOC. You have, some big swings, but you also have consistent singles and doubles versus just swinging for the fences. This is not like baseball. Okay. Diversity you need for consistent returns. The early stage yields give you better returns on the average. It's a good part of the portfolio, the way you construct your portfolio. You have shorter deals, higher IRR, longer deals where you do swing for the fences. You may get a 10, 20, 30, 200x return. Syndication and relationships dramatically expand deal flow quality. And that's why I was so big on developing the strategic affiliate program, where we have 5 strategic affiliates. They bring us deals in areas that we don't know, both in the markets and in the geographies. Otherwise, we may not hear of something. So I'm still looking to build strategic affiliates with certain entities in certain geographies. So we see those pockets of concentration of technology or market space that we can then review. We want to build a structured pre-screening process. Don't rely on what lands on your inbox. That's why, again, we TCA have been at the forefront of looking at AI, using AI for triage. And use data and AI, but keep human judgment in the final decision point. Again, big comment, humans in the loop. Thesis first versus inbox. Most angels are doing it backwards, and use AI as a tool, not the end goal of managing your DD process. Any thoughts?
Well, with one exception lately, where I did follow the AI trend and invest in a tool company, I have been trying to find deals that will be the next generation of success, because I think we're coming toward the end of profitability in AI. And this is a pitch toward next week's session, David. I'm going to talk about this in depth, and it is one that we have to know. However, if we're looking at the now I'm not talking just about finding the best deals. I'm talking about the general companies that are trying to use these tools and all the things that are coming from our investments. The term the great restructuring is a great way of saying this. Companies are having a hard time forecasting. They don't know what's going to happen next, talking about everything from tariffs to the ability to figure out what AI is going to do for them. And it's a very disturbed, mixed environment right now that we as angels can help in a way. Because if we provide portfolio companies that are able to help address some of these problems and calm down the industry, the great restructuring is going to happen, but it better happen with some knowledge and some tools. And so, yes, we need to find the best deals. Yes, we need to make sure those companies are successful. And yes, we have to get them into the best parts of the field, product market fit.
Yeah, well, it's leadership and product market fit are the top 2 criteria that guarantee or at least give you a higher probability of success. So I know we're going to run out of time, but I want to wrap it up with the final bottom line for both angels and entrepreneurs. So really 2 sides of the coin. AI, to your point earlier on, AI changes everything, but human judgment still closes the deal. Structure matters. You need to look at governance. You need to look at dilution, and returns, be they short-term and or long-term, deserve equal attention. You shouldn't just bet on the long term. You have to have a good complementary investment thesis. Speaking of which, a written investment thesis is a non-negotiable start in these markets. Entrepreneurs should also know the audience, because if they're presenting to a group whose investment thesis is different than what they're presenting, there's an incongruity and they will not be successful, waste everyone's time. Diversify deliberately. Barbell works better than inbox first. The best angel groups are building systems and support. We just do not write checks. Final comments from you?
Yeah,
any other lessons?
Comment on that. We just had the annual meeting, as I said, and there were 3 venture capitalists on a panel. And one of the things they talked about was know us before you approach us. We have investment theses, and there's no way that we're going to violate that thesis. And each of them gave examples. And it kind of brought home to the people in the room that we can guide people toward venture if we know which venture capitalists are the appropriate ones to guide them to. But, we have an investment thesis in a way. We're principally tech, for example. Retail is okay, but very hard to get through to us. And this whole thing about knowing the group is probably as important for the entrepreneur as any other single fact. The other one being, perhaps the other biggest fact being, don't overprice. Don't walk in the room saying I'm worth 10 million before there's been any proof. You're laughing, but it's true, and it happens all the time.
I'll tell you why I'm laughing. I mean, I don't know how many times you've heard it, but I know I have heard it so many times. Hey, I went to the Valley. The Valley is very interested in our deal. They say we're worth $15 million, but I'm coming back down to, because they said, first go to the angels. They'll give you the early money. We'll come in right after that. We'll give you that discount, only $10 million. The fact that we have no revenue, not important, but look at our spreadsheet, how good that looks.
Yes.
That's why I'm laughing.
I'll let you wrap it up on that one, because that is a fact.
I think this has been very interesting. I was so glad to attend the ACA. I think it's very valuable. It's great to build these relationships, because we, TCA, want the better deals. And a lot of the deals that are out there that have higher MOIC or IRRs are not necessarily within our local geography. So we need to reach out to others who have a better visibility. I think it's really important to consider using AI as a tool, keep the human in the loop. I hope the entrepreneurs as well as the investors got something out of this discussion. These themes are coming up over and over and over again. This is not just something that just popped into somebody's mind at one time because there was a conference. We hear these all the time. So what I wish everybody who is listening, if you like this podcast, share it. Share this information. It's really important to those entrepreneurs who are looking for funding. It's really important to those investors, especially the newbies that are coming in, that want to understand how to do this well and make it part of their portfolio so they can grow their portfolio. And with that, David, always great to see you. This has been a very interesting discussion for me, and very personal too. And I wish everybody out there good luck, good investing, and hope you get whatever you desire in terms of funding.